Hello and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on today's episode, I'm welcoming Alasdair Macleod to the program. A 40-year veteran of the finance industry, an expert in precious metals and sound money principles, and the author of the Macleod Finance Substack. Trump's tariff salvo is sending markets into a very severe downturn. Gold also getting hit, and particularly silver getting smashed. What does Alasdair think of these developments? Is this the big one? Are we headed for a brutal further downturn? And how will the precious metals respond in the long term? We're also, of course, going to talk about the massive outflows of gold and silver from the LBMA. Is this as significant as analysts are making it out to be? We're going to cover a whole lot of things, interesting times. So let's dive into it with Alasdair Macleod. Alasdair Macleod, always an honor to have you here on Commodity Culture. It's been a very interesting couple of trading days since Liberation Day, where Trump has unleashed a barrage of tariffs. We are now, however, now seeing some back and forth negotiation between certain countries. Vietnam coming back saying, we maybe want to go to 0% tariffs on America. Can we work something out? Canada now saying we're going to drop all the tariffs, which is funny because these politicians, Doug Ford, this buffoon, he was out there before saying, no matter what, we're going to ramp up, we're going to fight. They picked the wrong fight. And now he's like, could you please, we will now reduce tariffs to 0% if you do it. Are we good? So pretty funny, but also potentially a little bit tragic. Gold holding up better than most other assets at this point in time. It's 2.8% or so as we speak down. Silver, however, taking quite a beating, now sub $30 once again. What's your thoughts on Liberation Day, the after effects of these tariff announcements? Do you think this is a blip in the radar? Or do you think this could cause a further long-term correction in the broad market? And how do you expect gold and silver to react in that case?
Well, I think the timing of it is most unfortunate because it's the combination of the things that we saw in 1929 to 1930. And by that, I mean the popping of a credit bubble. This credit bubble is bigger, far bigger than we had in the wake of the Roaring Twenties. And also, at that time, we had the Smoot-Hawley Tariff Act. But the difference really between Smoot-Hawley and now is that in those days, something like 2 or 3% of American GDP, I think, was imported. That's not the case now. Consumers are very, very dependent on imports. And of course, you've also got supply chains. I mean, look at Microsoft, for example. Look at Apple in particular. Apple, they do the design in California, but everything else is outsourced, out to the Far East, China in particular. So this is actually very, very serious. It's a lot more serious than what led to the decline in Wall Street from the high in September 1929 to the low in 1932 of nearly 90%. This is more serious. It really is. And not only that, but these tariffs, and I mean the market's initial reaction rather confirms this, these tariffs are basically driving the global economy into recession, slump, depression, I don't know what we'll call it. And the consequences of that, of course, are that tax revenues will disappoint. Welfare costs will be higher than anticipated. Government finances will take this very, very badly at a time when government finances are actually in a debt trap. So you then have to ask yourself the question, well, how does this affect interest rates? Because everybody's assuming that interest rates will go down. The Fed will lower interest rates because they have to, and they're going to have to rescue the economy, etc. It's the Keynesian playbook, but it's complete rubbish. In fact, the correct way to look at this is the way the foreigner will look at, say, his investment in US equities. They've got something like 14, 15 trillion, depending on valuations, invested in US equities. That is a hell of a lot of investment. Now, they're not going to hang around while a bear market rages and just sort of sit on their position. No, they're going to sell it down. They're going to panic out. They're bound to. And are they going to go and buy US treasuries and corporate debt? The risk-free alternative? No, as far as they're concerned, that's not the risk-free alternative. The risk-free alternative is to get into cash in their own currency because they're running balance sheets in their own currency. If they're going to see no risk at all or minimal risk, it's got to be back into their own currency. It doesn't matter how bad the currency is. That is where the buying is going to go. And we've seen this reflected already in the dollars trade weighted, which, you look at the chart of that, it's awful. That's the only description I can give it. It fell 2% yesterday. It's like more than 2%. It's steadier today, but there's no doubt, looking at the chart, that's going to go below 100. It's currently 102. Going to go below 100, and it's going to be on its way to 90. And we see what happens then. Allegedly, Trump wants to see the dollar lower. He's going to get his wish. But this is very, very bad news because how does the foreigner then get enticed back into the dollar? The answer is you've got to offer him an interest rate to entice him back into the dollar. You then look at the consequence of interest rates on the debt trap. And oh dear, this gets worse and worse and worse. In other words, we're getting into this sort of maelstrom, if you like, whereby everything's going round and round and round and disappearing into the black hole of nothingness. That is basically what's happening. And it's happening to the value of credit. You cannot reduce the amount of credit outstanding without banks or businesses going bust. That is the way outstanding credit gets reduced. If it's not going to get reduced that way, then it gets reduced in its value. So what will happen is that the Fed will be pushed into interest rate policies which basically destroy the dollar. And we're just in the early stages of this. And as for the commodities, this reaction actually is completely wrong. But it's understandable, being the first, if you like, the initial shock. And bear in mind also that there's still quite a bit of leverage in the US equities. If you look at the FINBRA numbers, I think in February it was a short $1 trillion of debt, leverage in the market. That's getting caned, absolutely caned. So you can see that this is not good. It really is not. And first reaction to hit everything, including commodities. I think that the swaps, if you like, in gold and silver and in other commodities, the other futures commodities, are understandably trying to close down their positions. So they bash these prices, they bash them down. And of course, nobody wants to challenge them at the moment. They will manage to close some of their positions at a lower price. I don't think they will in gold. There might be some, but gold is interesting because on COMEX, there's less than 500,000 contracts outstanding, which is not an overbought situation, if you like. You don't have all these hedge funds long of gold, short of dollar. No, they're not at all. So the amount of stuff that's going to get shaken out on the bull tack, I think, is going to be disappointing as far as the swaps are concerned. Different position, obviously, in silver, because you haven't got central banks buying silver, which effectively is the backstop on gold. And on that basis, this is why silver has fallen by 6%, 6.95%. I see on my chart today, having had another very big fall yesterday. So that, I think, roughly is where we are, Jesse. It's interesting times. I see this in two phases. I see the initial shock, and then I see people looking at things a little more rationally, and then looking at the opportunities. And to my mind, the opportunities are quite simple. Because it's the dollar going down, buy commodities, buy precious metals. But it's going to take, if you like, things to settle down a little bit before people seriously consider that.
Hey guys, just a quick break to hear from our sponsor, ARC, silver, gold, osmium, for all your precious metals needs. ARC SGO is the place to go. Owner Ian Everard is trusted and given praise even by his competitors for being one of the most honest and informative gold, silver brokers in the United States. And their special is Silver Kangaroos 2023 1-ounce coins, mint fresh for $2.47 over spot. While supplies last. Take advantage of the offer by giving him a call at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. So do you think this could be the start of that often discussed capital rotation from overvalued tech stocks into hard assets in the form of commodities, particularly gold as a safe haven asset? Obviously, everything tumbling together, gold holding up better than the broad market, and the more speculative mining sector obviously getting hit harder than the broad market. Is this a matter of, once the dust settles eventually, and like you said, assuming this correction continues the way it is, we're going to eventually see a moment of rationality from some of the players in the game who are then going to shift their focus to the commodities sector. So in that sense, do you think commodities and gold and silver even could be a good place to be positioned right now, despite the recent downturns we've seen?
Yeah, I mean, the portfolio adjustment at this stage is quite simple, and that is it's sell equities, buy bonds. But bonds are actually the wrong thing to buy. I mean, particularly where you've got duration. Don't buy duration, for goodness sake. So that's what the regulators tell investment managers to do. And anyone who passes a CTA exam knows that, the way risk works in a portfolio is the balance between equities and bonds. Commodities are never mentioned. It's just not part of the whole scene. And indeed, physical commodities are not regulated investments anyway. So, the establishment, and we're really talking about the investment establishment educated by governments and by their regulators and all the rest of it, has a very, very clear and simple response under these circumstances. And what this means is that where you've got losses, basically you sell anything else in order to cover those losses. And that's what we're seeing in markets. And of course, the shorts in futures are, making hay out of it. I mean, they really are. That's why we got 7% falls today after 5% falls yesterday. But what we saw at the time of the Great Financial Crisis, I think we see again. At the time of the Great Financial Crisis, we saw gold get knocked from about $1,000. It got up to something like $1,050 or something. It got knocked from there down to about 680, and that was more, more spread out than this current episode. It took 3-4 months for that to happen, but once that was over, gold then went on up to 1920 in late 2011. Because you had the knock-on effects, if you like, of the Great Financial Crisis. Particularly, you had, if you like, European debt problems and all the rest of it. Various crises in Europe, which sort of rolled and rolled and rolled. And of course, everybody wanted to get out of credit and get into safety, which was really what happened. This time, I think the situation is actually far, far more dangerous. We might see the authorities trying to steady the equity market. That wouldn't surprise me at all. But look, what we're seeing is the largest credit bubble in history going pop. And it's going pop in exactly the same way as a lesser credit bubble in 1929 went pop, with combination of that and tariffs. Smoot-Hawley Mark II, I'm calling it. I think that rather like in 2000 and late 2008, the initial shock takes out everything, and then people sort of think, hold on a minute, gold is actually where we should be, not in credit, as it were. And I think we're already getting, this is not something else. This time, we got central banks doing it. Central banks are buying gold. Why? They're actually selling credit. They're getting out of paper currencies, they're getting out of fiat currencies. big message which we've got to hoist on board. That is the difference between 2008 and today. And of course, they don't buy silver, which is why silver goes down. They don't buy copper, which is why copper's going down. And they don't buy oil, which is why oil and energy is sinking. But that will turn round because over long periods of time, the purchasing power of gold is very steady when it comes to buying these commodities. So, all this is pretty temporary stuff. I'm not giving a steer in terms of timing. All I will say is that the downside in gold, I think, is extremely limited, simply because central banks are standing there just picking up any loose stock they can possibly pick up. So that's going to keep things tight in gold. We have a real crisis in the markets, and that is going to lead collapsing equity values. And I wouldn't be surprised if this crash continues next week, like big time. That sort of thing begins to affect the banks because the banks have this stuff as collateral, equities as collateral. And not only that, I mentioned the leverage, around about $1 trillion of leverage. It's less than that now. I should think it's probably around about 850 to 900 billion. But on top of that, you've got the commercial real estate problems and all the rest of it. I wouldn't be surprised if the next thing we see in a few weeks' time is a number of banks, if you like, being questioned about their survivability. The other thing, which is something that hasn't happened yet, is the collapse in crypto. That's going to happen. You've only got to look at how Bitcoin correlates with NASDAQ. It's the same, or particularly the Magnificent Seven. It's the same cohort who are long of Bitcoin, who are long of those Magnificent Seven tech stocks. Watch that Bitcoin. I don't make investment recommendations, but I would not be surprised to see that as one of the best shorts at this stage in the market. So we're talking about the enthusiasm, if you like, that you get in the top of a credit bubble. It's that's evaporating. And the consequences on values, the whole way across the board, can be catastrophic. So big warning to everybody.
Well, let's take a step back from financial markets at the moment and look at the potential impact of these tariffs on the American economy, because I've heard some different interpretations. One is this is terrible. Trump has no idea what he's doing. He's just going to destroy the American working class. He's going to punish Americans the most with this. And he's basically incompetent. And then on the other extreme, I see people who say he's playing 4D chess. He's actually thinking about the long term, and he's willing to cause pain right now if it means in the future the U.S. is more able to service its debts. And this is kind of a way of doing that, almost purposefully creating a recession and crashing the market. What are your thoughts? Is this something that could have any positive benefits for the American economy if we look in the long term? Or is this madness? Is it somewhere in between in your view?
I think the first thing I would say is that Donald Trump is a real estate developer come hotelier. Quite frankly, economics is not his bag. What he's done, I think, is he's gone back to the Constitution. The Constitution, before the days of income tax, used tariffs, if you like, as a means of paying government expenses. And so he's trying to get back to that. Now, I'm afraid that the situation today is not the same as it was before the First World War. It's very, very different. What he's doing is economically catastrophic, not only for the US economy, but also for various other economies. And I think, we just need to look no further than the members of the G7. The only G7 member which is not in a debt trap is Germany. And that's going that way anyway. So these debt traps are very, very bad news. And just for clarification, you get into a debt trap, basically, when your GDP doesn't match in terms of its growth rate, nominal growth rate does not match the growth of your debt. If the outstanding debt is growing faster than your GDP, then you are in a debt trap. It's the classic definition. Now, when we hit a recession, or slump, or depression, whatever that turns out to be, as a result of this combination of credit bubble bursting plus tariffs, then the consequences of that are that the debt trap intensifies big time. It really does, and the only way in which you can maintain the value of a fiat currency under those circumstances is to raise interest rates. But the problem is with the debt trap, if you raise interest rates, you make the problem worse. I mean, for some time, I've been telling everybody about how we had the similar problem back in 1975, late 75, 76. Sterling crashed. The Americans came and bought sterling, supported it. Then they sent in the IMF basically to tell the government, force the government, if you like, to cut its spending, balance its budget, and then it could get it could close its position in sterling. It was an extremely profitable operation for the American government at the time. But we had interest rates of 15%. I remember 3 gilt issues of coupons of 15, 15 and a quarter, and 15.5%. Just imagine that in dollar terms today. That's where we're going. It really is. And that's scary. That is very scary. What's going to survive that? I mean, which businesses are going to survive that? Indebted businesses. I mean, it's going to turn the lot into zombies. What's going to happen to the banks who have extended credit to these businesses? What's happening to the banks who have taken on collateral, which is valued at current levels on the assumption that interest rates are not going to go up? I mean, this. I just cannot see that there is a will, if you like, within the political circles to actually address these issues head on and deal with them. They don't have a mandate to do it, called the Overton window, which is the new, the new phrase. They can't open it wide enough. And I don't think they even know enough, getting back to what you were originally saying, questioning about, is Trump playing 4D chess? No, he's not. He hasn't a clue. And nor have all the others around him who is appointed as secretary of this and secretary of that. They've got no idea at all about economics.
Have you seen this post from Donald Trump on it's Truth Social, and it was also posted to X as well, basically telling Jerome Powell that he should be lowering interest rates. Jerome Powell's often too late. Now's the opportunity. Stop being political and cut interest rates. Do you think he's sending this messaging out there so he can blame the Fed for all of the negative effects of his actions? So we can say, I told Powell to lower rates, he's not lowering them. And so obviously that's the problem. Why would he do that in your view?
Well, I'm sure that he will blame Powell for the problems that he has created. Not Powell, but Powell has created a number of problems, but he's in a position where he hasn't actually been able to do very much other than what he has done. Because it's a the Fed is very political. It has to be. The idea that the Fed is completely independent and they can actually tell the US Treasury, go away, we're running this bit, you've got nothing to do with it, we will run this as we see fit. What? No way. This is complete political tie-up. And I think that I don't think necessarily that Trump is, being sort of devious and he's turning around and he's saying, I'm going to lay a marker so that we blame Powell when the whole thing goes wrong. I don't think he understands that it's all going wrong. I mean, okay, he's seen the market going down, and one of his guys, I'm not familiar. The names aren't imprinted on my rather small brain yet. But one of them was saying, well, of course, you're going to get this sort of turbulence in the markets because, there are lots and lots of companies which have been ripping off America. And of course, things are not going to go so well for them, or worse than that. I mean, honestly, you'd think that they planned this all along. They know what they're doing, and it'll all settle down, and don't worry. Yeah.
So, as an investor, do you think this is a time to be extremely defensive? In other words, sitting on the sidelines, potentially. Like, I mean, if we see a steeper correction in gold, I'll be a buyer for sure. Add some physical. But do you think this, in generally, is a time to play defense? You said traditionally, brokers and CFAs and people who are trained in the traditional financial system would now be looking to the bond market as a place to allocate capital. In the short term, I think you were alluding that could potentially be a place to deploy. I'm thinking maybe 90-day treasury, something like that. But what are your thoughts? Would you be playing defense, and is there anywhere in the market that you would be looking to deploy capital at this point in time?
Well, first of all, I'm not an investor. I'm an uninvestor.
Of course.
Get out of credit. It's credit that's going wrong. And really, it doesn't matter whether it's shares in the Magnificent Seven or US Treasuries or whatever. It's all going wrong. Get out of credit and get into real legal money. And there's only one thing that's real legal money, and that is gold. Also silver, but silver is not priced as money. And that's something that will have to change. So you're gambling a bit, if you like, if you go into silver for that to change. I personally think it will. But and don't go into ETFs. I mean, physical gold, possess it. That is the important thing, or at least store it somewhere where you can access it. Store it safely, fully insured, and all the rest of it. There are various forms. I mean, this is the business that gold money does, and there are others who will do that. So, but get it out of the banking system, because I mean, the problem when Roosevelt produced his executive order in late 1933, the banks basically took everybody's gold that they had in their possession, if you like, looking after it as custodians, and just made it over to the Treasury. It was the Treasury, I think, in those days. So, the banks will take it off you. And give you dollars, if you like, instead, which is not really what you want. Keep it out of the banking system. Don't have any credit. No, I know that's impractical. But basically, we're moving from a position really where, we're moving from trying to accumulate wealth to trying to protect it, preserve it. That's the key thing. And as I say, I'm not an investor. I'm a disinvestor.
Some great words of wisdom there, nonetheless. The massive outflows of both gold and silver from the LBMA have been a big story recently. There's a number of people I've talked to about this who say this is actually quite a major move, and inventories at the LBMA are getting low on a historic basis. I talked to Mario Ineco about this, Ed Steer. This is a topic that can get quite hyperbolic. Could you describe what you're seeing when it comes to outflows from London? Are these moves as meaningful as many are saying?
Yeah, they are meaningful. I mean, the people within the system are trying to dismiss it by saying, well, actually, all it is inventory is moving from one place to another, but it's not really changing. I don't buy that line at all. Basically, the first thing that happened was there were significant premiums on the futures market on COMEX. And this set in train an arbitrage, which basically cleaned the liquidity out of London, Switzerland, and even Mumbai. Gold held in bonded warehouses, not yet entered and therefore not yet taxed, went to London. I mean, it's the most extraordinary thing. So you have to ask yourself why, and the story was that there was the threat of 25% tariffs on gold, silver, everything. Now, I didn't really buy into that story. I could understand why it would trigger concerns, that there would be a possibility. Yeah, I can understand that. But there was something else there, and I think it's the to do with the stands for delivery on COMEX, because I've been monitoring these for the last 4 years or so. And particularly since Trump was elected, the pace of these stands for delivery in both gold and silver accelerated very, very substantially. To give you a clue, in the last year, 2024, the stands for delivery were a little over 2,000. No, hold on, no, I think it's 400 odd tons, something like that. The 2,100 ton figure I've got in mind is actually for the last 4 years, up until 2024. What has happened since then is the pace of these stands for delivery has accelerated. Now, with stands for delivery, we don't know, but the experience suggests that if you actually want to take position of your stand for delivery, it's not easy to do. And it's something that probably takes a certain amount of time and all the rest of it. So what we have seen in the past, particularly after COVID, we saw there was that peak, if you like, in stocks, in the warehouse stocks for gold and silver. And then the level of stocks declined and declined and declined into the beginning of the fourth quarter, 2024. Now that would reflect, amongst other things, people who stood for delivery withdrawing their bullion from COMEX warehouses. But there was probably still some which had not been delivered and therefore still there. Okay. Now, if we look at what's happened since the beginning of this year, over 400 tons of gold has been stood for delivery. Now, imagine that you're a bank, a bullion bank, whatever. Then probably what you're doing is you're saying, we could have a problem here. We need to get cover for those liabilities. And I think that is why we saw the premiums on futures jump to really very, very high levels, creating the arbitrage to suck in the liquidity from elsewhere. But then there is something else that has been triggered in this. It was really quite surprising in a sense that gold was leaving the Bank of England in large quantities, so much so that there was a significant backlog, I think, towards the sort of mid-April, we're getting to there now, of sort of, if you like, bullion banks or bullion owners trying to withdraw their gold. Now, let's be clear about this. This gold is not necessarily owned by commercial entities in the sense that they have probably leased it, so they have temporary ownership of it. While they have got temporary ownership of it, then they can do what they want, basically. So, the Bank of England has no power, as I see it, to stop them withdrawing their gold. The problem is that this is leased gold. Central banks are looking at this and they're saying, hold on a minute, we're buying gold in the markets because we're worried about the prospects for paper currencies. And, why should we be leasing gold at the same time when it goes out of the Bank of England and we're not necessarily going to get it back at the end of the lease? Doesn't make much sense. So I think the other thing that we're seeing in this is we're seeing the supply, which has been the liquidity pushed into the markets, bullion liquidity pushed into the market, if you like, providing the basis for the whole of the derivatives industry, both in London and also in New York. That supply of leased gold, providing that liquidity, is not there anymore. That's gone. That's going, and that I think is going to have a major impact on the future value of gold and the way in which these markets operate. And it's one thing when you see a derivative market, if you like, a derivative product expanding, and there's demand for it, and the system adjusts quite rapidly to produce the credit for that. But it's another thing when it starts contracting, and it's then that you potentially have systemic risks rising, and they could be rising very, very significantly. And because gold is fundamental to the whole thing, it could be that those risks actually also produce higher risks in other derivative markets, like foreign exchange forward settlements and other commodities, and all the rest of it. Interest rate swaps, I wouldn't put into that category because an interest rate swap doesn't involve the principal. It only involves, the principle is there if you like, but you don't, it's not settled in principal terms in any way. It's just an interest rate swap. But as for all the other derivative markets, a contraction of the gold derivative market system could have very nasty knock-on effects for the whole thing. And we're talking about hundreds of trillions of dollars of credit. So, I think it's a space to watch.
Let's hone in on China for a moment, because obviously they're now striking back with tariffs of their own versus the US. Japan also being hit with big tariffs. I'm not sure how South Korea plays into this. I'm sure they're affected by the tariffs as well, because we have seen top officials from China exchanging thoughts with Korean and Japanese officials on strengthening trade cooperation in the face of these tariffs. This is very interesting because traditionally, these are three countries that do not see eye to eye and have had tensions and outright wars between them for centuries. Could we see Japan and Korea, traditionally more on the American allied side, potentially start to move towards the BRICS? And then secondly, how does this whole situation that's played out with Liberation Day potentially change, either for good or for bad, the acceleration of the BRICS agenda?
I think it's very important. There is no doubt in my mind that China's thinking, and I think this is shared also by Japan and South Korea, their thinking is that America is basically out to screw them, if you like, just put it bluntly. And on that basis, they're far better having a trade alliance between them and, if you like, having a larger free market area, which would involve incorporating BRICS and all the rest of it. I mean, just look at it from the point of view, say, of the Koreans, let's say. Exactly the same for the Japanese. They're getting shut out of the American market because of these tariffs. That is as simple as that. So where do they go? Well, the answer is that China has actually, along with Russia, has put together Shanghai Cooperation Organization, BRICS. These are the more natural allies for the South Koreans in terms of trade. And, so it's time to bury the hatchet on previous enmities. I mean, completely. And I think this is a very major development. What we're seeing, Jesse, is I think we're seeing not just a whole new trade group evolving as a result of America's autarkic going in on itself and cutting itself off from the rest of the world. I think that this is we'll look back on it and see it as a very, very important time for the dollar, and how the dollar, in terms of its use for international trade, was getting frozen out. I mean, it's something which is very, very difficult to do, let's face it, because all commodities are priced in dollars, all this sort of stuff. But I think what we're seeing is the dollar, if you like, is getting killed as a result of these trade policies. And it's also getting killed because you've got a credit collapse going on, and you've also got, the global slump, which means basically less trade and all the rest of it. So there's every reason why the dollar is going to get killed. And I think that from Japan's point of view and South Korea's point of view, they're far better off coming to an agreement with China and saying, look, can we have access to your markets? Can we trade together? I mean, that's what I would do. I think it's simple, but this is where, at the end of the day, the Americans, I think, are going to get it so horribly wrong. I mean, they may, if they don't want to be the world's policeman anymore and want to not get involved with foreign affairs, etc., 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 pull out of Ukraine. Not so easy to pull out of the Israeli situation, but you can see that, okay, that's fine if that's what you want to do. But basically, by doing that, what they're doing is they're killing their own economy. As we've already discussed about supply chains all the rest of it. But I can certainly see that a new trade grouping. China would welcome it as well. I mean, the idea that they've got this powerful thing. They are already exporting more goods to BRICS nations than they are to America. So they actually, when they turn around and say, right, okay, we're going to 34% tariffs to America, which I think what they said this morning. We're going to keep very tight control on any rare earths going America's way. They can happily do that because they've got they've got these new friends who are in exactly the same boat from America's treatment. So, that is major. That is major, and you're absolutely right to ask that question.
And also their geographic location, they're all right beside each other. So the ease of transporting these goods is very, very easy. So I think strengthening that trade between them would be a fantastic idea. I used to live in China. I used to live in South Korea. I spent a lot of time in Japan. I would love to see those three countries kind of come together. I think it's a natural fit, as you've mentioned. Well, Alasdair, this has been a fantastic conversation, as always. Super enlightening. Tell us about the Macleod Finance Substack, what it is you do there, and where people can find it.
Basically, it's the link is alasdairmacleod.substack.com. But if you Google Macleod Finance, and hopefully Jesse, you'll put in a link on this, at the bottom of this interview. It's really keeping people informed about what's really going on with precious metals, the economics behind it. It's the understanding of the difference between money and credit, which, quite frankly, so few people do understand. It's been growing really quite rapidly. I've now got over 13,000 followers. The reason I want more is I want more and more people to protect themselves from all these dangers, which we can now beginning to see accelerating. And I think the collapse in equities, which I've explained why and all the rest of it, that's happening. That has very, very material implications for every saver, everyone with wealth to protect. And so I would urge everyone to think, about educating themselves about that. I think there are other sites as well as mine, though I am going to claim mine as the best.
Well, I'm going to put a link in the description below to the Macleod Finance Substack. I've read some of your work. It is super in-depth, super informative, so I recommend people check it out. Thank you once again, Alasdair, for coming on and sharing your knowledge with the audience.
Thank you, Jesse. Thank you for having me on.
And thank you for joining us today. As a reminder, this episode is brought to you by ARC Silver Gold Osmium. Give owner Ian Everard a call today to take advantage of their special Silver Kangaroos 2023 Mint Fresh 1 ounce coins for $2.47 over spot. While supplies last. The number is 307-264-9441. You can also hit him up by email at ian@arcsgo.com and make sure to tell him that Commodity Culture sent you. And I'll see you guys on the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.